on the question of the European Central Bank, we heard from one of your colleagues, in fact, from the Bank of Latvia, suggesting that another larger rate hike in September is appropriate. Would you align with the view that maybe another 50 basis points would be appropriate in September? Or has the front loading that we saw of last week given the ECB the opportunity to take a more moderate approach?
Well, obviously, we have decided to take decisions meeting after meeting. So there is no way now to say whether it will be appropriate 50, 25, or whatever. What we have decided was to front load an increase in interest rate that is basically a normalization. So we ended out from the negative interest rates, and we will see, depending on data, how to go on, but clearly this does not mean that we are not going to proceed in a gradual way. Graduality means moving step by step, not being very slow, and we are moving step by step simply because the inflation rate turned out higher than it was projected for a number of reasons. Interest rates, therefore, in real terms, were lower, and I think that we simply did a front loading of what had to be done. Markets have understood very well. There is no particular reaction. It is no time now really to ask for higher interest rates than we had up to now foreseen. Thank you.
Governor, how difficult was it to agree on that 50 basis points amongst the members last week?
It was not difficult. There was a long discussion, obviously. We have considered, as usual, all the elements for a decision. We had said in June in Amsterdam that we intended to raise by 25 basis points our official rates in July, and then actually inflation persistently was maintained at a higher level than it was expected, not only by us, by markets, by futures, and so on. And the reason is simply linked to the protraction of this incredible war in Ukraine. And this implies that the energy prices have been maintained much higher than expected. As a matter of fact, the gas prices increased up to 150 euros per megawatt hour, which means basically almost double than what they were in the spring, and extremely more than they were last year. So in this sense, it was simply a way to, as I said, front load our normalization path.
Okay, the importance of front loading, and of course you stress the importance of graduality as well, and taking it meeting by meeting. I just wonder, Governor, if we're able to get any clarity, given the data you're looking at now, as to where you see ultimately rates going, and when you expect rates to peak, and at what level?
When I expect what? I don't understand. What should I expect?
I wanted to get your views on when you expect rates to peak, when you expect them to get to the highest point they can get to, and on what kind of level you might be looking at this point.
No, I don't. So far, the conditions are such that both inflation expectations, wage prices, they are doing more or less in relatively positive way, reacting to this increase in energy prices, in inflation, and so on. Obviously, they may increase, and this is the reason why we normalize and we try to take care of the what we call second round effects by avoiding that there is an increase in demand. But actually now we are in a very different situation still with respect to other areas of the world. There is no major demand pressure yet, and the path of interest rates rises of normalization is going to somehow counter the risks. I don't see it really getting out of our hands. It seems to me that we are proceeding as expected. And obviously, the TPI is an instrument now that will help us to avoid excessive volatility, disorderly movements in markets following our decisions, and somehow misunderstanding what really the risks are.
And on the TPI, Governor, do you see any chance that Italy will indeed qualify for that kind of instrument?
Well, Italy, as any other country, TPI is an instrument that basically is designed not to protect a single country, but really to maintain a smooth transmission of monetary policy, which is meant to achieve price stability. Now, this is something that has to do with the incompleteness of our monetary union. We don't have a well-functioning banking union. We have delays in the capital market union, not to say the fiscal clearly union, or steps towards that, which are crucial for monetary policy to have a single counterpart in the macroeconomic framework. So in this sense, we are looking to a number of issues. The Governing Council will be autonomous in deciding when and how to intervene. The conditions are standard conditions. That is, we have basically the maintenance of agreement with the EU fiscal framework, the sustainability of fiscal conditions, the macroeconomic imbalances not to be there, and especially, I also would say, the permanence of sound and sustainable macroeconomic policies, which is something different from the developments of political systems. So any political change will come with different or possible maintaining the main policy decisions, objectives, frameworks, and so on. And the markets, as well as us, will have to value how much these will imply that the conditions are sustainable, and therefore any disorderly movements in markets will be unwarranted. The word unwarranted is really crucial.
Okay, unwarranted market moves is what we're looking at. And so far, the reaction from Italian debt BTPs is, as you said, relatively muted. But on the question of politics then, and of course, political risk in Italy back on the front pages last week, if we do get to a point where BTPs, where Italian debt yields are blowing out, whether it's 250 versus the Bunds or 300, and it is down to political risk, the suggestion is that the TPI tool would then not apply. What would happen in that context of a blowout of the spreads, but that is tied to political risk? What would then be the reaction to that?
I understand. The issue here is whether our policy changes and decisions have been interpreted by the market in making conditions more difficult for the Italian debt and so on. This is not so. At the end, there has been some turmoil, and I still think that the current spread with respect to German bonds is somehow much higher than what would be justified by the macroeconomic fundamentals of the country. But this is still something that has to do with the uncertainty the market sees in terms of policies. We have to really look at what will be at the end the policy framework that will take place in the country. I don't see particular risk up to now. I think that the most important thing for Italy is is to maintain the ability to return to a higher rate of growth than the one we had experienced in the last 15 years or so, or 20 perhaps. And the issue here is very simple. Much of the rise in the debt-to-income ratios, to GDP ratios, is due not to fiscal inability to be prudent or careful, even if I'm sure that much better could have been done in terms of distinguishing between current expenditures and expenditures for public investment. But at the end, it will be extremely important, the increase in GDP. If we had a GDP increase in the last 15 years as the one it was after the monetary union until the financial crisis, it would have been much below 100% today, that GDP ratio. So, I mean, this is really the crucial, what the policies will be, but the objectives are very clear, and the political system, I think, will have to follow those objectives as the way set by the Draghi government.